Hey everyone, just wanted to give you the latest of what's going on in the market, been on the road, so just wanted to catch up with you with everything that has been going on. The markets have been raging ahead following the buy signals that I had passed along, and unsurprisingly, the indicators for Bitcoin have turned positive as well. So we've got two positive of the three signals that I follow on Bitcoin have turned positive. So I'm up to a 100% investment of my percentage that I want to hold in Bitcoin now, and 50% of my allocation in gold, and I'm gradually buying into a eventual 100% investment back into stocks. When I get the indicators, I usually take 3 to 4 weeks to allocate back into an investment with stocks, as they can be false breakouts. With Bitcoin, things move really fast, so I tend to follow that more quickly. We had a 50% indicator on Thursday night, and then another 50% indicator on Saturday. So looking for 100% allocation to Bitcoin, a 50% or half allocation to gold still. All the indicators are not positive for gold yet. And then a eventual 100% allocation to stocks, and then the rest balance in cash. Now, when I say 100% allocation, that is of your portfolio. So some people may want to have 60% in stocks, 30%, 20% in gold, 10% in Bitcoin, and the balance in cash. And then the allocations are a percentage of that. So however you want to set your portfolio up, those are the allocations or the various categories I'd recommend separate of real estate. If you wanted to have real estate investments, is some allocation to cash at a money market rate, and then some in stocks, some in gold, and then some in crypto. Bitcoin is really Bitcoin and Ethereum, although Ethereum has not turned positive quite yet. So anyway, typically stick with Bitcoin. It's the most resilient right now. So that's all I got to say there. So anyway, 100% allocation to my allocation of Bitcoin, 50% allocation to my allocation of gold, working towards the 100% allocation in stocks, and then the balance would be in cash. So anyway, that's it for changes in allocations that I'm working on. Real estate is been really soggy this year to start, and is running below a 4 million home sale run rate so far, which is record lows, 40, 50-year lows when you population adjust. So we're just scraping along the bottom still. Interest rates have come back to about 6.25% in the last few days. Eventually, it's possible that the economy might slow down enough because of this oil shock that interest rates will go down, and that could push interest rates down. Of course, we are still in the middle of this oil shock. So the Strait of Hormuz is not open, and I still do believe that if we go another several weeks through the end of May, we will be looking at a potential huge distortions in various markets. I was talking to my brother this past week, and he is working with a company that makes plastics and sells plastic widgets, and their price has gone from 58 cents to 90 cents. And if they actually want to buy it, it says it's 90 cents, but it's actually $1.11. And they're looking at $1.40. So just imagine how many places plastics are put into various products throughout the world. And you're looking at a double or tripling in the cost for these plastics over time. And these have already started to move. So not even deeply into this problem in Asia, where these things are frequently in Southeast Asia, where these plastics are manufactured. So this problem could get much, much worse. And each of these items can cause shortages and then cause a factory to shut down, et cetera. So I am worried also about food and fertilizer stocks and all that. And the reverberations will get larger and larger the longer the Strait of Hormuz is closed. Right now, the economy is actually strengthening, or as it was this quarter. and late into this quarter before the war really got rolling. We are seeing some countries and some economies that are front loading orders because as soon as the war started, they started ordering stuff and pushing ahead orders just like they did with tariffs. So we're going to see a false boom here for the next few month or two, I would guess, as people are ordering extra to get their supplies in before the shortages hit in various markets. Where this hits, no one really knows, and we may see inflation getting much worse, probably in the 3 to 4% range. I wouldn't be surprised. The good news is Kevin Warsh will be moving into the Federal Reserve, and hopefully he will fire 2/3 of the 1,000 economists that run the Fed. But they have been incompetent the last 10 years, causing booms and busts, or 20 years. And Jerome Powell was the biggest culprit to push housing into an overpriced mode and a shortage mode where there weren't enough houses to sell. So good riddance to Jerome, Mr. Magoo, as you know, I love to call him. And hopefully Kevin will come up with a much better structure for looking at the economy and try not to be driving the Federal Reserve through the rearview mirror. So fingers crossed. We never know where we're going to go with those things. But one thing for sure is he is going to hopefully look at new way of doing things at the Fed, which building a $1 billion building is not a good way to be doing things, is my opinion. So hopefully a new way will be a better way. You never know. But anyway, that's it for those types parts of the economy. Like I said, the economy actually has been strengthening. Some of the service ISM reports have been showing strength, and there's areas profits are increasing. So remember, just because the stock market is going up doesn't mean the economy is getting better, because it's not. It's got to get worse when the oil shock hits. But profits are getting higher, and so stocks are going to go higher for now. How long this will last, we may have a sell indicator come up. I wouldn't be surprised. We're a little overbought now. Wouldn't be surprised if we see some retrenchment here. But things have gotten really strong, and a lot of the computers haven't bought in fully. There's still shorts out there, so it could go higher and higher before things start to settle down. So I do believe we're looking at some challenging times, fourth quarter and next year, but that's a long way away. So let's just stick for the weekly. We'll catch up with you later. Thanks.